Morning, sir.
Okay. Yeah, welcome to Taxation for Skills level in Equity Professional Academy. So my name is Mr. Idris Tunde. I will be one of the lecturers that will be taking you taxations for this diet November 2025. I'm glad to welcome you all to this class. My colleague, Mr. Wasiu, I've started this lecture yesterday, and I think he have gave out the course outline. So mine too, I will list out my own course outline. After the class, after the end of the class today, I will send the course outline to the group chat for us to look at. So this morning, we shall be looking at introduction to taxations. This morning, we shall be looking at introduction to taxation. That is the topic we are looking at. We need to introduce tax so that when we have the basic knowledge of taxation, by the time we move to calculations, we can have the understanding of how we arrive on some of the calculations. So let me remind us that November 2025 diet is going to be the last diet that some of the taxations in terms of the way we compute tax. Some of them, this will be the last diet that they will be using them. As from 2026, May 2026, there is a lot of changes in tax due to recent tax reform act that was signed into law by the president about 2 weeks ago. So the new law regarding tax that was signed into law by the president is going to take effect as from January 2026. So what I'm saying in essence is this may not affect our current syllabus. That means from January 2026, there will be a lot of changes in ICAN syllabus regarding to taxation, advanced tax, and there will be a lot of changes practically on how we compute personal income tax, on how we compute company income tax, on how we compute capital gain tax, because the new law have gave out the new rates that we are going to use. So let's take advantage of this diet. Let's be focused. Let's pay more attention to the class. If we don't have, if we, by the time we started lecture fully, if we have any issues, let's try to contact the lecturer via WhatsApp and try to ask questions. The more we ask, the more we know. So this morning, we'll be looking at introduction to taxation. We start with what is tax, definition of tax. As we all know, tax is a compulsory levy. Tax is a compulsory levy. That means compulsory contribution, compulsory imposition. Tax is a compulsory levy imposed by government on its citizens for economic growth and development. What this one means is that it is government that collect tax. And who pay tax? The citizen of the country. Take, for instance, in Nigeria, the citizen of Nigeria, the resident of Nigeria, as part of their own contribution to economic growth and development. What this one also means is that one of the key indents to economic growth and development is taxation. Taxation is one of the important fiscal policy of the government. So the clear definition of tax is a compulsory levy imposed by government on its citizen for economic growth and development. We use tax to develop economy, to growth economy in the country. That is meaning of tax. We go further that what is taxation? What do we understand by taxation? Taxation means can be defined as a system or process or method used by government in collecting tax from time to time. The system, the process, the method used by government in collecting tax from time to time is called taxation. That is distinction between tax and taxation. Now, let's look at objective or purpose of taxation. What are the objective or purpose of taxation? Why does government need to collect tax? What are the reasons that make government to impose tax on the citizen? Why? Why do we collect tax? Why? What are the importance for collecting tax? Number one is to generate revenue for government. The primary sources of government revenue is taxation. Without tax, government cannot exist. Government use tax to run the affair of the country. Government use tax to provide the dividend of democracy to the citizen. So tax is very important. Tax is very important in the country. So one of the major source of revenue to government is taxation. So to generate revenue to government is the primary objective of taxation. Another objective of taxation is redistribution of income and wealth. Redistribution of what? Income and wealth. Tax can be used to redistribute income and wealth. What do we mean by redistribution of income and wealth? Meaning that we are trying to reduce the gap, bridge the gap, minimize the gap between the higher income earner and the lower income earner. Government use tax to redistribute income and wealth by ensuring that they collect tax from the higher income earner. They use it to develop the rural area where the lower income earner reside. Take, for instance, those who are staying in Lekki, Banana Island, Ikoyi, and so on like that. They should pay more tax than those who are staying in Ikorodu, so that government can use that, can develop the tax that government collect from that developed area. They can use it to develop the developing area or underdeveloped area, so that in the long run, those who reside in those rural areas too, by the time that they are self-sustained, they will be able to pay tax. So redistribution of income and wealth is one of the key objectives of taxation. Another one is management of the economy. Government use tax as one of the tools of fiscal policy to manage the economy, to control inflation, to control economy. So management of economy is one of the key reasons why government collect tax. Harmonization of economic objective. Harmonization of economic objective. Government use tax to harmonize economic objective. What are the economic objectives? To provide full employment, to provide full employment opportunity, price control system, and so on like that. So government use tax to harmonize economy. Another objective of taxation is to protect domestic industry. To protect what? Domestic industry. Government use tax to protect domestic industry. Domestic industry means local industry. In some other area, we can regard domestic industry as infant industry. Those industry that are doing business in Nigeria, that are owned by Nigeria citizens, that are doing production in Nigeria. We need to protect them against foreign industry. We can use tax to protect them against foreign industry. How? Government will increase custom duty, import duty, so that those foreign goods will be very expensive. When those foreign goods are expensive, people will not have option than to patronize the local industry, the local good. By patronizing the local industry, the local good, that one too will contribute to our GDP positively. Because a country cannot grow through 100% through importation. I'm not saying Nigeria should not be importing, but we should be exporting more than importing. One of the crises we are facing up to today in Nigeria, because Nigeria is an import-oriented country. Virtually 70% of what we are using in Nigeria is being imported. So we are not producing locally. We are depending on importation, which is not contributing to our GDP. It's even affecting our foreign exchange rates. So government need to protect infant industry or local industry against those foreign industry by increasing the custom tariff, custom duties, import duties, so that the price of imported goods will be very expensive compared to local goods. So another objective of taxation we need to look at is to prevent consumption of harmful goods. That objective is not here. To prevent what? Consumption of harmful goods. Tax can be used to prevent consumption of harmful goods. How do we use tax to prevent consumption of harmful goods? There are some goods, they are harmful to our health. Cigarettes, tobacco, alcohol, all these goods are harmful to our health. Even in their product label, they will say, smokers are liable to die young. Smokers are liable to die young. That means those who are smoking the cigarettes, they are liable to die young. So government cannot say, don't smoke cigarettes. What we government can only do is by saying, drink responsible for those who are drinking alcohol. Smoke responsible for those who are smoking alcohol. For those who are smoking cigarettes. So government can increase the tax on those harmful goods. They can increase the tax on those harmful goods so that those who are smoking the cigarettes, they will not consume it in excess quantity. Or those who are drinking the beer, the alcohol, they will not consume in the excess quantity because the price has increased due to taxation. So it's one of the objectives of taxation. So to prevent consumption of harmful goods or discourage consumption of harmful goods is one of the objectives of taxation. Another objective of taxation is to preserve foreign exchange rates. To preserve foreign exchange rates. Government can use tax to ensure that we have a positive foreign exchange rate. That means our exchange rate have more our currency, our local currency have more value, appreciate against foreign currency. Government can use tax to preserve that, to ensure that the rate of exchange, the rate of naira to dollar, naira have more value. Naira is appreciating against dollar. Government can use tax to do that. How can government use tax to do that? Those foreign goods that we normally source for dollar to buy, government will impose more tax on them so that we don't have any option than to be using the local goods and using our local currency. And also encouraging exportation. By the time government encourage exportation, creation of export processing zone, and so on like that, all this will have impact on our local currency. Government will encourage exportation, will give incentive to companies that are exporting goods. By the time we start exporting, it will create more value to our local currency. So these are the objectives of taxation. Now, let's look at another area. Sources of tax law. What are the sources of tax law? Sources of tax law. For law to be making tax, what are the sources? What are the sources of tax law? Please, let's try to mute our audio. Sources of tax law. Where do we get law regarding to tax? Sources of tax law. Number one sources of tax law is the Nigeria Constitution of 1999. Number one sources of tax law is the Nigeria what? Constitution of 1999. The Nigeria Constitution of 1999 states it clearly the kind of taxes and levy that can be collected, the approved taxes and levy that can be collected by each tiers of government. What are the taxes and levy that can be collected by federal government? What are the taxes and levy that can be collected by state government? What are the taxes and levy that can be collected by local government? All this has been stated in the Nigeria Constitution. So, number one sources of tax law, like I said, is the Nigeria Constitution of 1999. Number two sources of tax law is called statutory law. Statutory law. Example of statutory law: Personal Income Tax Act, Company Income Tax Act, Value Added Tax Act, Capital Gain Tax Act, Nigeria Revenue Service Act that was just signed into law, Joint Revenue Service Act, Tax Administration Act, Nigeria Tax Act. All those are the recent law that was signed by the president. They are statutory law. They are those laws that pass through the legislative arms of government, that was deliberated and passed into law by the legislative arms of government, which is the National Assembly. They are the statutory law. Another sources of tax law that we have is called case law. Case what? Case law. For the case law, they are the law that arises as a result of tax disputes between the taxpayer and tax authority. There are some tax disputes that may arise between the taxpayer and tax authority, which either any of the party may decide to approach courts. Take for instance, take for instance, FRS versus FRS versus Shell Petroleum Development Country. FRS versus Shell Petroleum Company. When the judge make a final judgment on this case, that final judgment made by the justice, it will become a judicial precedent that other company can follow. It's now a case law. It's now what? A case law. It's now a case law. And in taxation, if any of the party, either the tax authority or the taxpayer, want to approach court, the first court that they need to approach is called Tax Appeal Tribunal. From Tax Appeal Tribunal, they will proceed to Federal High Court. From Federal High Court, they will proceed to Court of Appeal. From Court of Appeal, they will proceed to Supreme Court. Supreme Court is the final judgment as regards to any case we have in Nigeria. Another sources of tax law that we have is called budget speech. Budget what? Speech. There are some speech made by the president, declaration made by the president that can become a law in the long run. I remember in 1993, the then military budget speech is mostly common during the military regime. Budget speech is mostly common during what? The military regime. I remember in 1993, the then head of state, when they want to introduce VAT, value-added VAT tax. Value-added tax was introduced as a result of the budget speech of the head of state in 1993. And it take effect immediately at the time of signing the budget. It was later they now have to pass it into law. They now have Value-Added Tax Act decree. But value-added tax was first introduced as from the budget speech of the former head of state. So I'm saying example of budget speech. I remember May 2029, May 29, 2023. Our president, current president, said subsidy is gone. You can see that when he made that statement, all the filling stations adjust their pump price, and they believe that subsidy is gone without even passing the law, without even making the provision. That is an example of that budget speech. Another sources of tax law that we have is called customary law. Customary what? Law. Customary law. The customary law, they are the traditional law, the olden days law. Tax has been in existence for decades of years. I'm a Muslim. During the time of our prophet, there is issue on tax. Even in our Quran, there's something relating to tax. It's called sakat. Likewise, too, for those who are Christian, in the Bible, there are some issues that happen during the time of Jesus Christ that relate to tax. So in the Bibles too, there is something that we call for Christian, they call it tithes on your income. Ìdámẹ́wàá, I think, is it 10%? So it's tax. Tax has been in existence for thousands of years. It's not a new thing. It has been in existence. Even when we go to Nigeria, before the introduction of Christian and Muslim, our forefathers that are traditional, that are doing traditional religion, that are all doing this, they have been engaging in tax. They will call it ishakole, collecting ishakole from village, the traditional leader, the traditional ruler. So all these are sources of tax law. Like I said, number one sources of tax law that we have is Nigeria Constitution of 1999. Number two is statutory law. Number three, case law. Number four, budget speech. While number five, customary law. All these are the sources of tax law. So the next area that we need to go is classification of taxation. How do we classify tax? How do we classify tax? How do we classify tax? Classification of taxation. That is the next area we need to go. So please, let's have a break of 5 minutes. Hello?
Hello, sir.
Okay, we are back. Classification of taxation. Yes, we want to classify tax. Number one classification of taxation that we have is classification according to tax rates. Classification according to what? Tax rates. Under the classification according to tax rate, we have three types of tax: progressive tax, regressive tax, and proportional tax. Number one classification of tax that we have, taxation that we have, classification according to tax rate, and this classification according to tax rate, we have three types of tax under it: progressive tax, number one; regressive tax, number two; proportional tax, number three. What is progressive tax? Progressive tax is a tax system where the tax rate increases as the income level increases. A tax system where the tax rate increases as the income level what? Increases. That means, what progressive means is that as your income is increasing, the rate of your tax is increasing. Presently, personal income tax rate that we have, that we are using as of today, which is going to change as from January 2026. The personal income tax that we have as of today is progressive in nature. Look at it. First 300,000 at 7%, second 300,000 at 11%, next 500,000 at 15%, next 500,000 at 19%. And so on like that. You can see as the income is growing up, the tax rate is also growing up. That is progressive. As at present too, our company income tax is progressive in nature because our company income tax depends on your turnover, on the company turnover. If a company turnover range from 0 to 25 million, that means that company is a small company. Their company income tax rate is going to be 0%. But if a company turnover range from above 25 million to 100 million, that means that company is a medium company and their company income tax rate is going to be 20%. If a company turnover is more than 100 million, that means that company is a large company. Their company income tax is going to be what? 30%. So you can see as the turnover is going up, the tax rate too is growing up. It's progressive in nature. I remember in our secondary school days under economics, they will say progressive tax is a tax where the rich pay more than the poor. Because progressive favor the poor, it does not favor the rich. Number two, regressive tax. Regressive tax is a tax system where the tax rate decreases as the income increases. Regressive tax is a tax system where the tax rate decreases as the income increases. Regressive tax is not common, and we don't have regressive tax in Nigeria. That means regressive tax, it favors the rich more than the poor. We don't have that in Nigeria. The last type of tax we have under classification according to tax rate is proportional tax. Proportional tax is a tax system where the tax rate remains the same despite changes in income level. Proportional tax is a tax system where the tax rate remain what? The same despite what? Changes in income level. Whether your income is going up or your income is going down, you are still going to pay the same tax rate. E.g., our value-added tax is proportional in nature. Our value-added tax is what? Proportional in nature. It remains 7.5%. Either the turnover you want to pay VAT is 200 million or the turnover is 50 million. You are still going to pay the same rate of 7.5%. That is proportional tax system. We have talked about classification according to tax rate. Second classification of taxation that we have, that one is called classification according to incidence. Classification according to incidence. How do we classify tax according to incidence? There are two types of tax according to incidence: direct tax and indirect tax. There are two types of tax according to incidence: direct tax and what? Indirect tax. Direct tax, they are those taxes imposed on income. Direct tax are those taxes imposed on income or profit derived by individual, company, and corporate organizations and other corporate organizations. Direct tax, they are taxes imposed on income and profit. When you receive salary, you pay direct tax. When you make profit, you pay direct tax. Either for individual Individual can be sole proprietorship, employee, or partnership. Companies too. A limited company, PLC, they are company. They pay directors. These directors now, we can break it down into different types. Directors can be break down into different types. Number one type of directors that we have is called personal income tax. Number one type of directors that we have is called personal income tax. What is personal income tax? Personal income tax is a tax imposed on income derived by sole trader, employee, partnership, trustee, and communities. The tax imposed on income derived by individual, sole trader, partnership, trustee, communities. Personal income tax, as regards to an employee, is called pay as you earn. Personal income tax, as regards to an employee, is called pay as you earn. When you are an employee, your personal income tax must be deducted by your employer and remitted to the State Board of Internal Revenue. Personal income tax is collected by State Board of Internal Revenue, which is the state tax authority. Why company income tax? It is a tax imposed on profits derived by company engaged in commercial business transaction. Company income tax is a tax imposed on profit derived by every company engaged in commercial business transaction. I've said it earlier that company income tax rate depends on the turnover. If your turnover range from 0 to 25 million, your company income tax rate is 0%. But if your turnover range from more than 25 million to 100 million, your company income tax rate is 20%. If your turnover is more than 100 million, your company income tax rate is 30%. As at present, the recent tax law that was signed into law, which we commenced January 2026, has changed the modality of this company income tax rate. And company income tax rate is computed on the company total profit. Total profit means adjusted profit less capital allowance. Total profit means adjusted profit less capital allowance. Now, capital gain tax. Capital gain tax is a tax imposed on gain arising from disposal of chargeable assets. Capital gain tax is a tax imposed on gains arising from what? Disposal of chargeable assets. What are the chargeable assets that we have? Gains arising from disposal of chargeable assets. Chargeable asset means fixed assets like land and building, furniture and fitting, plant and machinery, motor vehicle, when you make a gain while you dispose them, take for instance, you buy an asset, motor vehicle, you buy it 2021. In the year 2021, you buy the motor vehicle 3 million naira. In year 2026, you now sell the same motor vehicle that you buy 3 million naira, you sell it 7 million naira. You can sell it 7 million naira, despite that you have used it. Why? Because the rate of exchange that we have in 2021 is not that the rate of exchange that we have in 2025. And if you want to go and buy the same motor vehicle, you will have buy it higher. So that motor vehicle appreciates. Land too appreciate. The land that you buy 5 million naira 10 years ago, if you want to sell it now, do you know how much you can sell it? You can sell it like 15 million, 20 million. It appreciates. The difference between the amount that you buy it, the amount that you bought it, and the amount that you are selling it now is the capital gain. Take, for instance, a motorbike that you bought 2021, 3 million naira, you are now selling it 2025, 8 million naira. Difference between 8 million naira sales price and the cost that you buy it, the difference between them is 5 million naira. That 5 million naira is the capital gain. The law said you must pay a capital gain tax at the rate of 10% of that 5 million naira, which is 500,000, is your capital gain tax that you pay to the tax authority. Who collect capital gain tax? Capital gain tax is collected by both Federal Inland Revenue and State Board of Internal Revenue. If the transaction involves company, it is collected by Federal Inland Revenue. But if it involves the individual, it's collected by states. And the rate of capital gain tax is 10%. Another type of direct tax that we have, is called petroleum profit tax. Petroleum profit tax is now called hydrocarbon tax. According to Petroleum Industrial Act, PIA, is now called hydrocarbon tax. This petroleum profit tax is a tax paid by company engaged in upstream petroleum operation. Petroleum profit tax, it is a tax imposed on a profit derived by company engaged in what? Upstream petroleum operation. What are the upstream? Upstream means those companies that engage in drilling, extraction of crude oil, drilling and extraction of crude oil. Those companies engage in such activity. Shell, Chevron, Mobil. They are upstream petroleum operation. So instead of this upstream petroleum operation to pay company income tax, they will not pay company income tax. They will either pay petroleum profit tax. On their profit. Apart from petroleum profit tax, another type of direct tax that we have is education tax. Education tax is another type of direct tax that we have. Education tax, it is a tax imposed on adjusted profit. It is a tax imposed on adjusted profit of every company in Nigeria. It is imposed on adjusted profit of every company in Nigeria. Either petroleum company or any other company. Apart from paying company income tax, apart from paying petroleum profit tax, they will also pay another tax called education tax. Education tax is otherwise called tertiary education tax. What is the rate of education tax? As at present, education tax rate is 3%. There was a time it was 2%. At a time, it was 2%. At a time, it was 2.5%. Apart from education tax, another type of direct tax that we have is called technology tax. Another type of direct tax that we have is called technology what? Tax. This technology tax, it is imposed on a profit of a specified company. It is not every company that pays technology tax. It is a specified company. Example of a company that pays technology tax, company that make use of IT, information technology most, e.g. telecommunication company, banks, insurance company, internet service provider, all the companies that make use of IT most, they paid technology tax. What is the rate of technology tax? 1% of profit before tax is the rate of technology tax. 1% of profit before tax is the rate of what? Technology tax. And for such company that are specified to pay technology tax, before we can ask them to pay technology tax in a particular relevant year of assessment, their turnover in that year must be more than 100 million. That means if a bank have turnover less than 100 million, they will not pay technology tax in that year. But if their turnover is more than 100 million, they will pay technology tax, which is 1% of profit before tax. So that is it on technology tax. You know, let's go back up. Let's go up. We said classification of tax according to incidence. There are two types of tax: direct tax and indirect tax. We have explained direct tax. We now say direct tax has different types of tax: personal income tax, company income tax, capital gain tax, petroleum profit tax, education tax. Now, let's go to indirect tax. Indirect tax. Indirect tax is another classification of tax according to incidence. Number 2, indirect tax. Indirect tax, they are those taxes imposed on goods and services. They are those taxes imposed on what? Goods and services. And these taxes, they are borne by the final consumers. These taxes are borne by who? By the final consumer. That is indirect tax. They are borne by the final consumer. They are borne by the final consumer. That is indirect tax. This indirect tax, we have different type of tax under indirect tax. We have different type of tax under indirect tax. What are the different type of tax that we have under indirect tax? Custom duties, excise duties, value added tax, stamp duties. They are all under indirect tax. Custom duties, excise duty, value added tax, stamp duties, they are all under indirect tax. That is all we need to say on classification of tax according to incident. Direct tax, we have different type of direct tax. Indirect tax, we have different type of indirect tax. Now, let's go to another heading called another heading. This one is called principles of taxation. We are still on introduction to taxation. Now, we want to look at principles of taxation. These principles of taxation, some textbooks call it canon of taxation. Canon of taxation. C-A-N-O-N. Canon of taxation. It is an attribute of a good tax system. An attribute of what? A good tax system. Let's look at those principles one by one. Those principles of taxation, let's look at them one by one. Number one principle that we have, this one is called principles of conveniency. Principles of what? Conveniency. These principles state that a good tax system should be based on ability to pay. A good tax system should be based on what? Ability to pay. It's talking of, this principle is talking of timing and method of collection of tax. It should be convenient to taxpayer. The timing and what? Method of tax collection should be convenient to who? To the taxpayer. The timing and method of tax collection should be convenient to who? To the taxpayer. That is principles of conveniency. What do we mean by method of tax collection? How does taxpayer pay tax? Taxpayer pay tax through bank. Sometimes they will go to bank and go and pay tax. Can you imagine, assuming you cannot pay tax via your bank transfer online? Before, tax payment is not convenient to the taxpayer because taxpayer has to go to bank, and it is not ordinary any bank that you can go. There are some dedicated bank that collect tax. There are some branch that you can go that collect. It's not all the branch of bank that you enter and you say you want to pay tax. There are some dedicated. Can you imagine the stress that you are going to pass through? Going to bank, you have to queue, you have to collect teller. Sometimes they will say network is not going. But as I'm talking to you right now, through the introduction of a software by FRS, tax is now convenience to the taxpayer. That software is called Tax Pro Mass. That software is called Tax Pro Mass. It makes tax to be. So, timing of tax collections too. Tax should be collected after the end of the year, after the end of the month. Take, for instance, our personal income tax is remitted not later than 10th of the following month. Personal income tax that was deducted on the salary of the month of June must be remitted not later than 10th of July. Why? So that it should be convenient to those that want to pay it. They should not pay tax before they have even before they pay them salary. No, it is after they receive salary that they should pay tax. A company, it is after company make profit that they will pay company income tax. They should not pay tax in advance. So that is principles of conveniency. Another principles of taxation that we have is principles of simplicity. Principles of what? Simplicity. This one is saying that tax should be written in a simple and unambiguous language. Tax should be written in a straightforward language that is understood by the majority of the taxpayer. Tax should not be complex. We don't need big grammar in tax. It should be stated in the language understood by the taxpayer. Simple language. Even if the taxpayer is maybe the taxpayer is a Yoruba man, he does not understand English. You as a tax authority, it is your responsibility to let him understand in Yoruba language. So sometimes if the tax authority want to make publication, sometimes if the tax authority want to make publication. They will make the publication in the 4 major languages. What are the 4 major languages? English, Yoruba, Igbo, and Hausa, so that people cannot claim ignorance of law. Another principles of taxation that we have is called principles of economy. Principles of what? Economy. Principles of economy. This one is saying that, these principles say that the amount of revenue realized from tax should be more than the cost of tax administration. This one is saying that tax should be a cost-benefit analysis. The benefit that government will derive from the tax, the revenue government will derive from tax, should more than the cost government incur while administering tax, while collecting tax. Take, for instance, if FRS collect 200 million in a month, for example, they should not spend more than 200 million in that year, in that month. They should spend less than it. What they should spend should be less than what they realize. So the revenue realized from the tax should be more than the cost of administering tax. Tax should be a profit something. It should be a profit venture to the government. Government should not be spending 100 billion in a year on taxation. They are now realizing 80 billion. That means it's not profitable. They are not seeing any gain. That is principles of economy. Another one is principles of equity. Equity means fairness. This principle is talking about fairness. Every taxpayer should be treated with fairness, equity. There should not be bias in taxation. There should not be sentiments in taxation. Every taxpayer should be treated in an equal manner, meaning that either you are Igbo or you are Yoruba or you are Hausa, you should be treated in an equal manner. There should not be sentiments based on tribe, based on culture, based on religion in taxation. No. That is principles of equity. Another principle that we have is principles of certainty. Certainty means the amount of tax, how tax authority arrive at the amount of tax a taxpayer will pay should be clear enough to the taxpayer. It should not be so complex. The tax formula should not be so complex that people will find it hard to understand. No, it should be certain. There is no secret in taxation. Show them how you arrive at the tax. You tax authority, explain to them how you arrive at the tax that they're supposed to pay. That is what certainty is talking about. Another one that we have, principles of flexibility. Tax should be flexible enough. Flexible in the sense that tax should be changed from time to time as there is changes in economic reality, economic environment. Tax rules should be changed. You can see, for us to agree that tax is flexible enough, you can see that there is a 4 recent law that was passed that was approved by the president of just of recent. That means a lot of changes will happen in tax. That means tax is not static, it's dynamic. As there is changes in circumstances in the country, changes in economic environment, changes in business environment, changes in political environment. There should be changes in the tax law too. Tax should be based on current trends of the economic reality. All these are the principles of taxation. Now, another area we need to go to is called tax system. Tax system means tripartite of tax. Tripartite of taxation. That means element of taxation. Element of taxation. Tripartite of taxation. Majorly, we have three elements of taxation. Element of tax system. Number one is tax policy. Number two is tax law. Number three is what? Tax administration. We call them tripartite of tax system. Tax law, tax policy, and tax administration. These are the tripartite of tax system. What is tax policy? Policy means general statement, guideline, published by who? By the tax authority, by the tax administration, guiding tax from time to time. The general statement, guideline, published by the tax administration, the tax authority, or published by government from time to time, that guides the day-to-day conduct of tax system in Nigeria. They are the tax policy. That general statement, as I'm talking to you today, we have what is called National Tax Policy, published by the Minister of Finance, like 4 years ago or 5 years ago. This National Tax Policy is a document that contains set of guiding principles, rule, regulation that regulate tax system in Nigeria. What are the objectives of national tax policy? One of the objectives of national tax policy is to guide the operation and review of Nigeria tax system. To guide the operation and review of what? Nigeria tax system. Another one is to provide guidelines for the review of Nigeria tax system. Another objective of national tax policy is to provide guidelines for the review of what? Nigeria tax system. Why another objective of national tax policy is to provide basis for future tax legislation and administration. To provide basis for future tax legislation and what? Administration. Another objective of national tax policy is to provide benchmarks with stakeholders, to provide benchmark on which stakeholder shall be accountable, to provide benchmark on which stakeholder shall be what? Accountable. All these are what? Objective of what? National tax policy. We are talking of element of tax system, which is tripartite of tax system. We have talked about tax policy. The next one we need to talk about is called tax law. What are the tax law that we have? We have different types tax law. We have Personal Income Tax Act, Cap P8 LFN 2004. Company Income Tax Act, Cap C21. Elasa. Company Income Tax Act, Cap C21 LFN 2004. Petroleum Profit Tax Act, Cap P13 LFN 2004. Capital Gain Tax Act, Cap V1 LFN 2004. Cap C1 LFN 2004. We have different tax law. Just of recent, there are new 4 tax law that we have. National Service Act, Joint Revenue Service Act, Tax Administration Act, Nigeria Tax Act. They are the new tax law that we have just of recent. The third element of tax system that we have is called tax administration. Who administer tax? Tax authority. The day-to-day management of tax lies with the responsibility of tax authority. Who are the tax authority? Federal Inland Revenue Service, State Internal Revenue Service, Local Government Revenue Committee. They are the major tax authority that we have. Apart from these people, we have another body called Joint Tax Board. Federal Inland Revenue Service, they administer taxes and levy relating to federal government. State Internal Revenue Service administer taxes and levy relating to state government. While Local Government Revenue Committee administer taxes and levy relating to who? Local governments. Now, the last for today, problems or challenges of taxation in Nigeria. What are the problems or challenges of taxation in Nigeria? What problems or challenges that face taxation in Nigeria? Number one, poor tax administration. Poor what? Tax administration. The tax administration, the tax authority, they don't have adequate knowledge of tax. They are not well equipped on knowledge of tax. Those who want to collect tax, they don't even have the basic knowledge of tax. Most of the people that are in the aim affair of tax administration today, working in tax administration, most of them, they are not even having knowledge of taxation. Some of them, they are even non-accounting graduates because it's based on connection. And some of them, they complain that their remuneration, their salary is very low. They are not motivated. So it's one of the challenges of taxation that we have. Another challenges of taxation or problems of taxation in Nigeria, multiplicity of tax. We have one of the problems that is facing SME, small, medium enterprise in Nigeria, is because of multiple taxation. Duplicate of taxes. Duplicate of taxes. On one income, you receive 200,000. When you receive that 200,000, the person that pay you the 200,000, when he want to pay you, bank deducts like charges from the person. The charges is about 300 naira. While you are receiving the money in your bank account too, bank will deduct charges again, stamp duty, electronic transfer levy, blah, 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 SMS charges. Federal Inland Revenue, we want you to come and pay value-added tax on that. State government, we want you to come and pay personal income tax on that income. Local government, we want you to come and pay land use on the same income. That is multiple taxes. Multiple taxes means a situation where similar or different, where different tiers of government impose similar tax on the same income. Out of 200,000, if we calculate the taxes you have paid already, it will be going to like 60,000 or 50,000. So what is the remainder? And if you put the money in your bank every month, they will still be reducing it with their bank charges. So a lot of multiple taxes in Nigeria. One of the key mandates of this tax reform committee that was formed by the president is to look at the issue of multiple taxation, because research have shown that what key SME most in Nigeria, what key business most in Nigeria is because of multiple taxation. Another problems of taxation that we have is lack of accountability for tax revenue and expenditure. One of the reasons that people don't pay tax, one of the arguments that they argue is government that collect our tax, what does government use tax for? They are using it to buy private jets, to renovate building, to buy car, bulletproof car, to do this. So the taxpayer, the citizen, they believe that government is not using the tax judiciously. They are not using it efficiently for what they're supposed to use it for. That is one of the reasons why they don't need to pay tax, why they are engaging in all sorts of different tax evasion. Another problems of taxation or challenges of taxation that we have is lack of public enlightenment. People are not enlightened on why they need to pay tax. They are not educated, sensitized on the reason why they need to pay tax. They did not enlighten them very well on the importance of tax. So lack of enlightenment is one of the reasons. Lack of public enlightenment is one of the challenges of taxation. Another challenges of taxation that we have is high level of corruption. High level of what? Corruption. The corruption we have in Nigeria is too high. Even on the part of the tax officials too. Bribery and corruption on the part of tax official. Bribery and corruption on the part of tax official. They are undermining government revenue. Sometimes the tax authority collide with the taxpayer to understate the taxpayer income, so that the taxes the taxpayer will pay will reduce. Bribery and corruption is one of the problems and challenges of taxation in Nigeria. Another problems or challenges of taxation in Nigeria is overdependence on oil revenue. We are so much dependent on oil revenue, and when the price of crude oil crash, it affects our revenue. It's just of recent we are now focusing on taxation. We are now focusing on how can we improve our revenue. Government can improve their revenue from tax, apart from oil revenue. Before, 60% of federal government revenue is coming from oil. We have depended so much on oil revenue. That is the reason why we have not developed the most area in taxation. It's just of recent government is now making a lot of reform as regards to tax system in Nigeria. It's a challenges to taxation. So all these are the challenges or problems of taxation in Nigeria. So we have done with introduction to tax. If you have any question, any observation, let's try to ask so that we can call the class a day. Any question?
Yes, sir. Hello, sir.
Okay, go ahead. I can hear you.
Okay. Hey, you mentioned something about company income tax the other time. Maybe they based on making use of the profit of the company now. Like for instance, now, how much is the rate like the government is charging for company income tax from each company?
Okay, thank you very much.
Huh?
Thank you for asking the question. Mr. Mr. Aziz, is it Mr. Aziz that asked the question?
Yes.
Okay. Company income tax rate depends on the company turnover. Though we apply the company income tax rate on the profit made by the company. But for some company, they are small company. Their turnover is less than 25 million. If such company make a profit, they will not pay tax. They will not pay company income tax because their company income tax rate is 0%. But if in a particular year, a company has a turnover that is more than 25 million, like 75 million turnover, such company will pay company income tax. And the company income tax rate the company will pay. The company income tax rate the company will pay is going to be 20%. We use turnover to determine the rate of company income tax. Once we determine the rate of company income tax, either 20% or 30%, if the turnover is more than 100 million, it's 30%. We now use that 30% times the profit, the total profit made by the company. We use the 30% on it. We use the 30% on it. Hope your question is
Yes, sir.
attempt to. Yeah. So any other question?
Yeah.
Any other question?
Then also another question. Yes, sir.
Okay, go ahead.
The other question is because at least based on task
I
now,
can't
the
hear
number of
you.
mission,
I
like you
can't
mentioned
hear you
something under
clearly.
which is like Nigeria Acts, Nigeria tax.
Yes.
Okay, it's the network, sir. You mentioned something the other time now, like there's already a new law in Nigeria now. And then you mentioned something about Nigeria tax act. And
Okay.
you also mentioned another one which I can't get due to the network.
You know what you do? You can send message to me via WhatsApp so that I can attend to you. The network is breaking now, so I will attend to your question, or in the next class, before we start, you can ask it. So the network is breaking. Thank you for having me.